So not only did I start this on mute, but Teddy's come upstairs now at the very beginning of the call. So let me start again. So usual story, an hour together. You can ask any question you like, and it's got to be to do with investment, obviously. And Laura's rattling the biltong box. Let's see if that lures him back down into his lair. Yes. So I will summarize markets and just give you my take on what's going on in the economy, what's going on with markets. And of course, it has got interesting recently, because if you look at what's happened to the Nasdaq, we had a fairly sharp sell-off today, which kind of reflects, it echoes what happened last week, which is that we had a fairly sharp sell-off in the Nasdaq again. It did recover since then, and now it's sold off again. So it seems as if this narrative about AI is starting to wobble. And the reason, I think, is that people are now starting to question, okay, it's a transformative technology, but is it going to hit the bottom line of these companies? Or is the CapEx, the capital expenditure, required to make it work, and also to hire the researchers, to build the models, maintain the models, train the models? Is that going to be so expensive, along with the energy required to run the AI, both for inference and training? Is that going to erode what profits it generates? So as always with investment, you get this period of euphoria with a new technology where loads of new applications are created and people are jumping ahead in terms of expectations. But then ultimately the companies have to deliver, and they have to show that this can generate profit and increase their bottom line. And I think that's the question. Is the CapEx going to be more than paid for by the boost in profits? And if it is transformative, where are the dollar bills going to fall? Are they going to be in the users of the technology, the providers of the technology, or maybe the downstream beneficiaries of the technology? So that could be the chip makers, and it could be other companies which produce the infrastructure for energy, for example, required to feed the models. So I think that's why we've had this wobble. And of course, these were expensive stocks. A lot of the mega caps were, crazy valuations. Interestingly, I was just looking at this. If you break it down by company, let's just pop this up on the screen. So this is Ed Yardeni. All praise to Ed Yardeni. Thank you, Ed, for these graphs. This is the price to earnings multiple, the forward price to earnings multiple for a whole bunch of the mega cap 8 stocks. So what have we got here? We've got Tesla, which is currently running off the chart. It's at 216 times forward earnings. Now that is not rational pricing. Tesla is not rational at the best of times, the investors in Tesla, but now they've gone, way off the scale. Whereas if we look at the remaining Mag 7, the remaining ones, they're all under a forward price to earning multiple of 40, but still none of them I'd say were cheap. The cheapest of the bunch currently on that measure is Meta at 20.7 times forward earnings, but they're all looking quite toppy. Nvidia 32 times forward earnings, Alphabet 26, Amazon 31, Apple 33. So clearly that's a high valuation. That's a state of euphoria. People are pricing in a huge amount of optimism and perfection in future earnings growth, whereas in fact it's going to be a bumpy road. There will be misallocation of capital, there will be mistakes made, and it will disappoint at some point because the expectations are just so high for what's going to happen with AI. And I think the interesting graph is this one, which I use quite a bit actually. It's kind of interesting. So if you look at what I'm looking for is the breakdown. Yeah. So if you look at the composition of the S&P 500 and look at what proportion of it the Mag 7 make up, actually the Mag 8 here, Mega Cap 8, it makes up about a third of the index, which is huge. You compare that with where we were in 2014, and these same stocks made up 8% of the index. Tiny. Furthermore, the proportion of the index they made up was roughly in line with the forward earnings share of those companies. So if you took all of the forward profits predicted for all of the S&P 500, looked at the proportion that came from the mega cap 8, it was in line with their market cap share. What we see now is a huge premium that people are paying for those companies because of that narrative. And remember, the forward earnings price in optimism about future earnings growth, which will price in what earnings is going to come from AI. So a third of the index is the Mag 8. They make up a quarter of forward earnings, so way more market cap than earnings share. And in terms of forward revenues, they only make up about 13%. So that's why I'm worried about this. The natural place for this blue line to be would be on top of the red line, which is the proportion of forward earnings which these companies make up. So that's the problem, I think. So could we see the froth come out of the market even more? Yeah, I think it would only be rational to see a bigger sell-off over the weeks ahead. But look, this is why we diversify. And when I made a video about what we can learn from the AI bubble, from the dot-com bubble, one of the very clear lessons was that if you kept away from the epicenter of the problems, which was the tech sector in the US, if you had a globally diversified index, then you wouldn't have suffered so much. Of course, you'd have had a loss, but it wouldn't have been as catastrophic as it was in that tech sector. So I think as long as you haven't kind of bought into this and gone overweight US mega cap stocks, I think that the pullback will be fairly muted because these are very strong companies, very profitable. Of course, the AI companies themselves, OpenAI, Anthropic, are not yet profitable. But the companies which have bought into the technology and which are developing it very rapidly, like Microsoft, they've got fortress balance sheets, lots of income from other sources. So that's why I think there won't be a huge catastrophic loss as a result of this. So I wouldn't panic. I don't think this is a time to panic. This is just a natural market repricing to something which is more natural. Was it triggered by anything? Probably not. Often these things don't happen for any obvious reason. If anything, there was positive news because the US shutdown was ended, which on the face of it should be good news. Maybe people are worried that we're actually going to get the payrolls data now and it's not going to look good. And, President Trump is going to have a fit and fire someone else. Who knows? But there wasn't an obvious trigger, I don't think. If we look elsewhere, risk off move generally, I think would be a fair description. So European markets have done what the US did, but less. So the FTSE 100 fell 0.4% during that week ending November the 7th. That was last week. And it's continued declining. So as of today, I think it dropped about 1.1%. And the DAX 1.6% is how much it fell in early November. And then November the 13th today, it fell about 1.4%. So, everything else is going to be dragged down by the US. That's always the case, right? So if the US is risk off, it's very unusual to see other markets being risk on. If we look at emerging markets, those have had an unbelievably good year. And I've made a video about that recently. So I think that hasn't dropped yet, but it will. And usually emerging markets are the riskiest part of the market, and yet at the moment they're actually powering ahead. So they've hugely outperformed developed markets and the US in particular over the course of this year, which is very unusual and partly justified, I think, given US valuations. Looking at bond markets, it's kind of interesting. Everyone says it's a catastrophe when yields rise, but what we've actually seen is yields falling. So if you look at the 10-year gilts, for example, those peaked at about 4.7% in early October, but now we're talking about, 4.5% for UK 10-year yields. So, 30 basis point fall is, reasonable news, given that we've got this big budget coming up and there are all sorts of worries about UK growth. But of course, if you get lower growth, that's what happens. Yields fall. and bonds rally, they feed on economic bad news, which is why they're a good equity hedge usually. And in the US, what have we got? We had a 6 basis point increase in 10-year yields over the course of the month. And it looks like markets are now pricing in a rate cut. So 2-year yields decline slightly. Of course, the short end of the curve is going to be driven by monetary policy expectations. The dollar index, we had a bit of strength. We've had a 10% sell-off in the dollar index, which is pretty shocking. That's part of the reason why the emerging markets have done so well. But yeah, it's difficult for the dollar, it seems, to rally to any great extent. And I think a large reason for that, the big driver of that is the economic policies of the US right now. Trade policy, political policies when it comes to foreign relations. There are many issues with the US economy right now, and we've seen the labour market weaken, and probably we'll see growth weaken as well, but there aren't any tangible signs of that yet. And of course, we're going to start getting data now that the labour force survey is going to be back in action. So we will get the payroll numbers and we'll get the employment numbers, and it probably won't paint a pretty picture of what's going on in the US labour market. So I think that kind of summarises markets. Gold still expensive, trading above $4,000 an ounce mostly. It touched 4,400 earlier this year, and we have seen it tumble a bit. So it's now, I think, around 4,200. Let me just get the latest price. So what is it? It's AU gold price. So currently, the Royal Mit's got it. Gold price. Oh, it's in pounds. How ridiculous. Gold price in dollars. Here we go. XAU USD. Yeah, 41.53 currently. So quite a long way below its peak, but is this a good time to buy into the rally? Probably not, because it's still overpriced based on our models anyway. So let me quickly share that model with you, and then we'll turn it over to your questions. Then I'll summon my cockapoo and feed him some treats, because he deserves it. Get the trackers, and we'll pull up gold. So obviously you get this as one of our premium members, but let me share this with you. Yeah, so I've just been writing the code for this quite intensely recently, and so I've been making lots of commits to GitHub. So I've taken a kind of semi-holiday tomorrow so I can work on this code, so hopefully it should improve a bit as well. Just kind of getting things in order. But let's have a look at the valuation. So this is the UK yield curve, but let's pull up gold's valuation model. So 3 inputs to this model. One of them is the strength of the dollar. So strong dollar, weak gold. Another is inflation. Gold usually tracks the value of inflation, the CPI index in the US. And the third one is real interest rates in the US. So high interest rates is bad for gold. So as rates are falling, that's good for gold. That's one of the reasons for the rally. But if you look at the current price and look at the model's expectation of where the price should be based on those 3 factors, that predicts that it should be at about $3,100 an ounce. It's actually at 4,200. So way overpriced, 37% overpriced. And silver as well, quite overpriced. 53% overpriced. So that's the reason why I wouldn't be piling into gold right now. I just don't think it's going to stay at these levels. It is looking a little bit like the peak we saw around 2011, 2012, when gold went crazy, and then it went into a lull for the next 5, 10, 15 years. And that's the trouble with gold. It has these incredible rallies, and then it goes into a kind of quiescent phase for the next decade. So, don't be caught out by that. everyone's trying to buy into this rally, and I'm just slightly worried that you'll be providing exit liquidity for the people getting out. So that's my summary of what's going on. I hope that was helpful. Let me just move some things around on the screen. If I minimize that, which you can't see, and then move it down here. Good. Brilliant. So what we're going to do is I'm going to summon Teddy for a treat. So he'll get a burger and a little mini burger, and then some biltong, and then you can ask some questions about anything you like. Probably markets, probably the sell-off is my guess, but it's his burger. He loves these. Ted! Thumping on the floor. So hopefully he'll come up. Here he comes. Right, you're going to stand? You're going to stand? Show them you stand. Don't put your paws on me. Good boy. Brilliant. So anyway, yeah, any question you like, and I'll be happy to answer. He's a good boy. He usually gets one of these in the morning as well. Good boy. Oh, good lad. He's gained weight. I've got to buy him a new harness tomorrow, my day off. That's my other goal. He's got a little bit tubby. You're going to go downstairs now. Get some biltong. Biltong. There he goes. Brilliant. So yeah, please do ask a question, and please do super chat. Please do like and subscribe if you haven't already. Obviously, I do these for free, and it helps me and it helps our company if you do a super chat. Please do, and we'll talk about markets, and I'll answer your questions. But I will push the people who've done a super chat. You'll be pushed to the front of the queue for your questions. I see we've already got 2 super chats. That's great. Thank you so much. I really appreciate that. And the first one is from Johnny B 2005, who says, surely to beat the market, all you have to do is predict what big investors will want to buy or sell in the future. Psychology is more important than fundamentals. Oh, that's an interesting one. But I'd always be wary of a sentence that starts, surely to beat the market, all you have to do. Because this is one problem that everyone has worked on. You know, anyone who's in markets has had a go, right, at trying to predict markets. You know, they've either done it just finger in the air stuff, you know, I feel it in my waters, or they've built predictive models, and none of them work consistently. You know, that's what efficient markets means. So can you predict what big investors will want to buy or sell in future? I'm not convinced you can, because it's all a bit circular. You know, if take an example, right? So the meme stock craze. Retail investors identified little bad companies which they thought would turn around, and everyone piled in through Reddit forums. There was lots of community on those forums. People were kind of egging each other on to trade these things in a highly levered form with derivatives, which caused a gamma squeeze, and the companies shot up. Now at that point it was rational for large investors, hedge funds, even real money like pension funds. It would have been rational to buy those meme stocks, even though they were often awful companies, because they were driven up by buying. If you get more buyers than sellers, the price goes up. It doesn't always have to be because of fundamentals. So like you say, it is about psychology, but it isn't always the psychology of the institutional investors, the big investors, which drives markets. Often it is, and that's usually the case, but not always. So you can't predict who's going to be driving the market. To some extent, it's driven by fundamentals. So if you're going to trade on the basis of valuation, I bought UK small caps for that reason. They were very cheap. I bought US small caps for that reason. They were very cheap. But I had to be very patient in order for the multiples to normalize slightly. And that's all that's happened. They have normalized slightly. And I made reasonable money on my UK small cap portfolio. I think it's up about 30-20%, something like that, since I bought it. But you just got to be really patient with these things. So don't expect the market to, tug its forelock and say, "Oh, you're right. I must have mispriced that." That doesn't happen. Things stay mispriced for a very long period of time. Look at Tesla's valuation, over 200 times forward earnings. Is that rational? Not really. So who's going to buy? Who's going to buy what? You just can't predict it. I mean, to some extent, this is why, buying an index by definition is what people buy. So it is a kind of, I think that makes it harder for fundamental investors, which look at fundamental valuations. They look at what's cheap, what's expensive. They go long the stuff that's cheap, short the stuff which is expensive, maybe. I think for those investors, it makes their life difficult, the fact that there is so much index investing, price insensitive buying. But, there will always be opportunities for fundamental investors. But there is a question about whether index investing has distorted markets. And I think to some extent it has. But can you predict what big investors will want to buy or sell in future? Maybe, you can look at themes. But in order to do that, you've got to get ahead of the game. You've got to predict it before they do it. Otherwise, the price will have gone up already. And for a theme like AI, well, that's completely and utterly priced in. So, yeah, I mean, what would be the next thing? Maybe quantum computing. But of course, there's lots of narrative about that already. So those companies are already expensive. You can bet that by the time you find out about it, lots of other people will have already invested. So it is difficult, I think, to have that mentality and try and predict these things. I'm not convinced you can. I don't think I can, certainly. But psychology is definitely what it is. It is a beauty contest in that sense. This is what Keynes said about it, which is that it's not about predicting what stocks are going to go up. It's predicting what other people think about the stocks that are going to go up, which is kind of what you're saying. But even that second order thinking will not work consistently. So not easy. And it's not all you have to do, right? There's all sorts of other things. But if you are going to be a value investor, just be patient, is what I'd say. Because some things are mean reverting. If valuations are high, usually they fall back. If they're low, they usually fall up. They rise. So there are mean reverting variables, and those are one way to maybe outperform markets. But don't have too high a hope. Don't set your hopes too high when it comes to fundamentally driven investing. It often doesn't work, unfortunately. Next question is from Charles Gibbons, who says, pension with Scottish Widows. I'm invested in Scottish Widows Global Growth Fund A accumulation. Feel it's more value than unrealistic growth. Opinion. The fee is 0.45%. Well, let's have a look at it. Now, a growth fund, a growth stock, is a stock where you let me just get that fund first of all. Okay, here we are, and I'll share. Yeah, growth stock is a stock where you expect it to outperform the rest of the market because its profits are growing more quickly than the rest of the market. So, for example, with tech stocks, their growth in earnings is huge. So if you look at Nvidia's earnings growth, it is huge, and that's a growth stock. A company where a value stock is the opposite of growth. So value would be things like stocks which are underpriced relative to their current earnings. So you're not paying up for growth in the case of value stocks, you're paying for mean reversion. You're expecting that this price to earnings multiple is too low compared to history, compared to the rest of the sector, compared to other countries, compared to its own history, and you think it's going to mean revert upwards relative to those profits. So that's what a value stock is. Growth is the opposite. It's looking for outsized growth relative to other sectors, other markets, other companies. So here we've got that fund. It's been around for a long time, gosh. So it goes all the way back to 1999. If we compare that with the NASDAQ 100, that's the blue line, you can see the level of, the degree of underperformance here. Let's add another thing. Let's add MSCI All Country World Index, because that's kind of a global equity index. And again, we'll go all the way back in time. So the midline here is MSCI ACWI, the All Country World Index, which again has beaten that fund. So let me get rid of the NASDAQ, because that's kind of raising our hopes a bit too high, I think. Yeah, so the black line is the Scottish Widows Global Growth Fund, where you're paying 40 basis points-ish. How many basis points? Yeah, you're paying, oh gosh, according to this, you're paying 87 basis points, 0.87%, which is a very high fee. Let's just double check that, because that does seem very high. Is that the right share class? Yeah, 0.9, 0.81 was it? Gosh, that's very expensive, 0.87%. I'd expect spectacular for performance for that fee, but that's not what we see. So this thing has underperformed a global index fairly significantly over a fairly long period of time. So since 2009, over that period, it's underperformed very significantly. If I switch back to a log plot, you can see the scale of the difference there. So, is it a great fund? No, it hasn't performed particularly well. I'd always be wary of a fund where you're paying 0.87% anyway. I think that's far too high nowadays. You can buy a growth fund for far less than that. And the way you do that is to look at a growth index. So, I don't know, let's go for MSCI World Growth. And we can find an index, which is MSCI World Growth. Now, obviously, this is a factor which has done well because of US tech stocks, which capture this factor very well. So if we look at the constituents of this index, obviously it's heavily weighted towards, the Mag 7, Nvidia, Apple, Microsoft, Amazon, Broadcom now, Alphabet, Tesla. And what you'd expect is that these are very expensive stocks, so you're also going underweight value. Remember, growth and value are opposite factors. You've also gone underweight size. So instead of going for small caps, you've gone for those mega caps. There's a big tilt towards these, $4 or $5 trillion companies like Nvidia and Apple and Amazon and Microsoft. So that's the tilt which you've got. And if you want to find how you can buy that more cheaply, I'd go to Just ETF, for example, and look at by category and just look for growth, global growth. Is there an MSCI World Growth? I'll just search for the word growth. Yeah, so growth ETFs. And here we go. So what are the fees for these? Let's sort by fee. The cheapest, Amundi Russell 1000. So that's Russell 1000. That's US large caps, I think. Growth stocks. There's a BNP Paribas Easy Growth Europe. So that's a European growth fund. Europe Growth, Total Market Growth Euro, US Growth. So that one's hedged into sterling. It's a pretty small fund, 6 million. That may not be around for long. The fee there is 0.49. So these aren't cheap, it's got to be said. But yeah, this is how I'd find growth funds. But 0.87 is very expensive, I think, for that style of investing. And the one I buy actually is a Scottish Mortgage, which is also a growth fund, and it buys all sorts of funky stuff, which is not listed because it's an investment trust. My location UK. I agree to everything. Go. Individual investor. Oh gosh, my capital's at risk. Right, so anyway, I like this because I love reading the annual report. I like the themes. I like the allocation. Let's see if we can find the pie chart. I've got this lovely pie chart of the portfolio. Top 30 holdings. Here they are. So they've got SpaceX, which you can't buy because it's not publicly listed. A lot of these companies weren't listed, but now they are. So, for example, it bought Spotify before it was listed, and now it is listed. ASML. You know, what they try to do is to find trends, and then they find the companies which they think, at least, are going to lead those trends globally, and they invest heavily in those companies. You know, whether they're listed or not. They did it with Tesla, and now they're doing it with many other companies. So, yeah. And it's got a very strong growth style of investing. And the fee there, I think, is 0.37 last time I looked. Where is it? Documents, fee. Fact sheets. There we go. Share. So here are the chaps that run it. Tom Slater, Lawrence Burns. I would like to interview them, but they won't talk to me. So the fee, ongoing charge is 0.31. And when it gets scaled, when the fund grew larger, they cut the fee. I love that. You know, I just wish more funds would do that. You know, they're reducing their own profit, but they did it. You know, I think that's great. And it's got a little bit of leverage, so it's got a bit of, you know, gearing of 11%. Not a lot, but a bit, which will have a cost with it, of course, because they have to borrow in the market to invest that money. But it's now operating at a discount. So it's, you know, if you add up the value of the assets, which you can do in this case, a lot of them are listed. If you compare that to the current price, it's trading at a discount to the net asset value. So that is, it shows that it's out of favour, but it also shows that it possibly is a bargain. So yeah, anyway, I think that's another company which I like in terms of style of growth. So I hope that answers your question. Not that key on your choice, but the style of investing, yeah. The problem with it at the moment, of course, is that it's very expensive. If you go for growth, you're going to be buying the Mag 7. If you go for quality, you'll be buying the Mag 7. So you have to combine quality and value, or quality, value, momentum, in order to have a style combination, which I think is better. That's what I did with my UK stocks. It was quality, value, momentum, and the stocks in my portfolio, 2 from each sector in the UK, small caps, which satisfy those criteria, and it's done pretty well. The next one is from Amir Ketobchi, who's our regular contributor and regular super chatter. So thank you, Amir, for your super chat. He says, what do you think the best case outcome is for investors from the forthcoming budget? So here we're talking about the November 26 budget from Rachel Reeves, and the worst. Thanks and keep up the good work. Well, first of all, let me say I'm a bit peeved. I wasn't invited to number 10 to meet Rachel Reeves. Lots of other creators were. Why is that? You know, I'd have loved to have gone and have a chat, you know, and talk about policy. But I think the biggest risk is that this is going to be, obviously Labour wants growth. Of course they do. Every government wants growth. To actually achieve that with government policy is very difficult. And I think one of the policies which backfired quite badly was the national insurance increase, because what that's done, it's a lot of the UK service sector a lot of it in hospitality, where people aren't paid a lot, obviously, but to employ them becomes much more expensive if you've hiked national insurance and increased the minimum wage. So that has had a dampening effect on growth, which is clearly not what the government wanted. I think their planning reform stuff is a growth positive thing, but it's going to take a while if it works at all. And there's always going to be a reluctance for people to allow planning, because you've got this NIMBY factor where people don't want development. They don't want new runways. They don't want new infrastructure for data centers in their back garden. It's just natural not to want that. But the government's trying to push that through, which is going to be difficult. So the best case outcome, I think, would be more growth positive policies. The difficulty is that Rachel Reeves has hamstrung herself in the sense that she's so careful about not increasing debt to GDP over this Parliament, that it restricts how much she can stimulate the economy. She can't spend; she has to tax, and that's not the way to growth, right? That if you want growth, I buy into the thesis that you have to spend in order to stimulate it, and there's got to be shock and awe. You've got to really show markets that you mean business, and be very decisive and make unpopular moves which are growth positive. And I think the infrastructure choices which the government's made are right, but I don't think they've been large enough or aggressive enough to really move the needle. And I'm concerned that they're just going to go through this Parliament, won't have achieved their goals, and will just lurch onto the next party to, hopefully fix the problem. But yeah, clearly she's going to have to raise more tax because of those constraints on debt. So I think it's likely to be something, I think it should be one of the big three, VAT, national insurance, or income tax. Those are the easy ways to raise more income. But things have been leaked about fiddling with pensions, and I'm concerned about that. Changing cash allocations for ISAs, forcing UK investors to invest in British stocks. All of these things I think are not going to change things. But I understand that they've got to raise more capital. But I'm just concerned that the changes they make won't fix the problem, which is productivity growth. If you want the UK to become more productive, you've got to invest in people. You've got to educate people so they generate more income every hour, every day, every year, because that's what productivity is. It's how much value add you've got, how much revenue, how much income you generate given your country's resources. And for us in the UK, that's been pretty stagnant compared to the rest of the developed world. And to fix that, I think, requires education. You've got to upskill your workforce, and that's not something which we've done. So I think those are the problems, and it's not an easy fix. I don't have any obvious solutions, and I don't think the government does either. I think some of the things they're suggesting are good, but yeah, I think they just haven't done it decisively enough and aggressively enough. And I think you've got to be aggressive with these things. But anyway, the budget, who knows? Please don't fiddle with the pensions. Please don't force us to buy UK stocks, because I think that would also backfire. Having people with lower incomes and lower savings as a result of being forced to invest in the UK is not the way to stimulate UK growth. It's not because companies are starved of capital. I don't think that's the case. I think it's more to do with the education of the workforce, our choice of Brexit, which has damaged growth. You ask the Bank of England, you ask other economists, and there's fairly strong consensus that it was a huge mistake and that it has slowed down UK growth. So an obvious one would be somehow to, make it easier, reduce trade frictions with Europe if possible. But, we've kind of screwed that up, which is unfortunate. But that would be an easy win if it could be done. But anyway, I'm concerned that she's going to fiddle with pensions. That's going to be the really difficult one. And, if she does increase taxes on workers, well, that's also going to take money out of people's pockets, which doesn't go into growth, which they can't then spend, and that could slow down the economy further. So I think this obsession with debt to GDP, while it seems prudent, I think it's actually a scar that's left in the psychology of all governments now following the Liz Truss budget, which actually is going to, crush UK growth as a result. I think some spending probably would have helped a lot, but if debt to GDP goes to 105%, 110%, is that a catastrophe? I don't think so. And we could actually stimulate enough growth such that debt to GDP would fall consequently. But, that's not the choice they've made. Anyway, that's my take on it. And those are my concerns. Next question is from Charles Gibbons, who says, opinion on Life Strategy 80 for an average investor. Well, first of all, let's say what Life Strategy 80 is. I mean, a lot of the people I speak to use it, the Life Strategy funds. So the idea here is that you buy an off-the-shelf fund which is globally diversified, the equity component is, and it's 80% stocks, 20% bonds. In fact, we can look at it. Let's just quickly have a look at the fund itself and its asset allocation. Life Strategy. Let's see if I can spell it. 80. Here we go. Okay. So here they are in order. So 20% equity, 40, 60, 80, 100. So this is the idea here, is that the primary driver of return in your portfolio is how much stocks you've got and how much bonds. So let's have a quick look at the average returns for stocks and bonds going back over the last 124 years. Let's do it in dark here. So for equity, the average real return has been 7% in the US, 5% in the UK, above inflation. For bonds, 2%, 1% above inflation. And for money market funds, bills, short-term government bonds, 0.5% to 1%. So equity has been by far the best performer, but of course with lots of volatility. Bonds about 4% less every year on average, so big fall in income generated, and then bills 1%. So if you've got 60-40, actually that's the allocation I've typed in here, the average return of your portfolio would have been historically about 5% in the US and about 4% in the UK. Real return, that is, above inflation, which isn't bad at all. So let's do 80, 20. Well, now the return's higher because you've got more equity. And these are just averages, remember. There's also volatility to think about. So 5.6 versus 4.6. And let me see if I can just quickly work out the Life Strategy Fund returns, because this is just a beautiful graph, which I love to use. And every time I look at these Life Strategy funds, I always think, gosh, I'd like to thank Vanguard for making them. Because they just illustrate this risk-return trade-off beautifully. Let me see if that works. Yes, it does. Beautiful. Right, I'll share this with you. Now I'll show you this one. Yep. Right, I'll move my R code over here. Whoops. So these are what the Life Strategy Fund returns look like since their inception in 2011. So June 2011 is when they were created in the UK. And it just beautifully illustrates the risk-return trade-off. So which one's the most volatile? Which one's the most wiggly line? Well, Life Strategy 100, because that's got 100% equity. The annualized return is about 11% over this period, which is, if you remember, not too far off what you'd have expected from those Dimson-Marsh-Staunton numbers, where you'd expect about 10% nominal, 9% nominal in the UK, But since 2011, we've had a bit more than that. We've had about 11. So that's unusually high. But that's 100% equity. That's a global equity fund with a UK bias. Life Strategy 80 has generated 9.3, so that's this line. Then we've got 60, 40, 20. And Life Strategy 20 still hasn't recovered from the crash due to yields rising in 2022, 2023, which is kind of interesting. But, is Life Strategy 80 suitable for everyone? I don't think so. I mean, it's got some bonds in it, but not a lot. If you wanted to replicate this, you can do that very easily. Just buy a global equity fund, 80% of your money in that, and 20% in a safe, short-term-ish government bond fund like gilts, or a money market fund, or a UK gilt fund like VGov. And you will replicate these numbers pretty closely. Not perfectly, but pretty closely. The reason why I prefer that is you've got more flexibility. So let's say that equity markets, these are rebalanced daily, but if you've got the two separate levers, risky, safe, then when equity markets halve, say, you can buy more equity at a point of your choosing when equity's cheap. Or if bond markets halve, which they didn't quite halve, but if they fell catastrophically, you'd buy more bonds. You'd sell some equity and buy bonds. So that rebalancing you could then control. And in retirement, that's really important, because if you're selling some of this fund just to live, to eat, then if it's rebalanced daily, you can't choose what to eat. You're eating a little bit of the bonds, you're eating a little bit of the equity. And if it's 80-20, you're eating 80% equity, 20% bonds. You've got no control over that. But if you have got control over that, you'd eat the bonds after an equity market crash, and you'd let the equity recover, and then you'd start eating the equity. And that way, you kind of eke out the pot for longer. So that's why I prefer to have the control myself over the rebalancing and what I eat if I'm in retirement, because that way you can eat the thing which is best for you. In accumulation, yeah, I think this is a really simple solution, and it's probably good for some people. But 80% equity is not suitable for everyone, because you could be a very cautious person, in which course a cautious Persian. I am a cautious Persian, but you could be a cautious person and not want the volatility that goes with 80% equity. In which case you go for 60. 60 is the most common one. That's the most widely used one with the biggest AUM. I don't think they show the AUM on the page itself, but yeah, 60 is usually the most popular. So I'd say that's the bog standard, 60% equity, 40% bonds. But the thing I don't like about Life Strategy is the UK overweight. It's got a 6-fold UK overweight. So instead of having 4% UK equity, it's got something like 6 times that market cap weighting, which is a very big overweight. And it has caused a penalty in terms of return until quite recently, which I don't like. But yeah, I think for a one-stop shop, for someone that's new to investing, I think choosing one of the Life Strategy funds is a good choice, because it's low fee, it's diversified, and it just works. You saw the graphs. I just love those. Anyway, thank you for asking the question and letting me look at those. Dimitrios Vasios, 2375. Thank you for your super chat. You say, can you comment on JSE South Africa performance? It's been up 50% this year, and it's not affected much by S&P 500 drops. 0.85% up today, right? 7% up from previous week. It's not something I'm familiar with, to be honest. I think you mean the JSX, don't you? South Africa. Johannesburg Stock Exchange, I thought it stood for. Let's see if I can find the index. I mean, that in itself is it's a difficult thing to find. JSX. Tell me if JSX is not what you meant, but I'm going to look it up if I can. I don't think I can even find it. I'll tell you what, let's look up MSCI South Africa, because MSCI is pretty good at producing single country indices and comparing them with world, EM and so on. Here we go. So let's have a quick look at the returns here and see what we make of it. In fact, I recently made a video on EM. I don't think I spoke about South Africa in particular, but maybe I did. Maybe it was one of the graphs I looked at. But it's true of much of EM. It's done incredibly well this year. Brazil, Poland, many countries have performed very well over the course of 2025 and beaten the US, which is kind of interesting. I wonder if I can find my EM graphs here. Yeah, I think I can. So let's have a quick look at the... can I do that? Move that over here. No. Okay. But then let's look at the MSCI South Africa here. So the annual performance, yeah, pretty good. And let's look at since in 2000, it's up about 9.1%. It's better than emerging markets generally, and a lot better than All Country World Index, which is only 7.3 over that period. And you can see the performance over 2024 was 16, which is very good. Sorry, that was ACWI. 6, 1.5, minus 3.88. So not so great in 2024. 6 versus 16 for global. 1 versus 21 in 2023. Minus 4 versus minus 18. So it didn't fall as much in 22 because it doesn't have as much tech, I suspect. Let's look at the sector composition. I'm guessing a lot of miners and banks. Yeah, so materials 34, financials 32, consumer discretionary 18, and then a smattering of other indices. So, what are they exporting? I'm guessing a lot of it is things like, just look at the top 10, gold, diamonds, platinum, So, if the price of gold's gone up a lot, well, clearly that's going to be good for South Africa if they're exporting gold. So I think that kind of explains why they've done well. It also kind of explains why they might not do well if the value of gold does normalize to something which is closer to, I shouldn't say fundamentals, but the drivers of gold, which is looking quite likely at some point. And if that happens, obviously that's going to be pushing South Africa in the opposite direction. Anyway, I think that kind of explains why. It's because of the commodities. That's why it's performed well. But would I pile in? Well, for the same reason I'm worried about gold, probably not. Not right now. I mean, there are other EM countries where it doesn't depend on things like commodity prices or dependency on the AI narrative, where it really does look like they've got some kind of fundamental shift in the economy, which has gone into a new gear. So I talk about that in my video about EM. So do have a look at that. I think it's not published yet. And then the last one, Ashlapabal. I'm not sure how to pronounce your handle, I'm sorry. But it's a super chat in Polish zloty. Thank you, Ashlapabal. And they say, hi Ramin, given your gold model, why do you think central banks in Poland, China and other countries buy gold so much and push price up even more? Well, I think obviously some of these countries are worried about falling foul of the US, and that means they want their reserves to be in something which doesn't depend on the US financial system or the dollar. Now, the reserve currency that people often use is the dollar, but if you're Russia or China, well, do you really want the US controlling your finances? And if they lock you out of the dollar system, you're kind of screwed. And they can confiscate your assets in the most extreme cases if you fall foul of them politically. So I think that's one of the reasons. We've also seen countries like Italy and Germany repatriating their gold out of the US back to domestic vaults, even though that's very expensive, because I think there's a lack of trust. People don't trust the US when it comes to the financial system, when it comes to things like collaboration. You know, the fact that Donald Trump was willing to tear up trade negotiations, which the US had done over decades. It had set up things like the World Trade Organization in order to get free trade, fair trade, but then completely ignored it, you know, with his decisions about the tariffs. So I think that's the gold price reflects a lack of trust. And that lack of trust is likely to continue, and that'll probably keep the gold price up while it continues. If we move from the current government of the US to something which is more, how can I put this tactfully, conventional, then I think the upward driver for the price of gold would go away. And that could be a big problem if you've gone heavily into South Africa or anything else which depends on the price of gold. So that would be my concern. But central bank buying certainly has been one of the drivers. But then, of course, momentum is another one. When people see the price going up, lots of people pile in, and we see these rallies extend far longer than they should, fundamentally. And I think that's also been behind the gold rally. But, you know, interesting questions tonight. Thank you for that. So I'll just double check I've answered everyone. I think I have. Yes. Good. Okay, so no more questions, please, because I'm going to miss them if I end the live stream. So thank you all for joining us. I hope it was useful. Hope you enjoyed it, and I hope you learned something. Please do listen to our podcast. So let me just find our podcast. It's called Many Happy Returns. Of course, it's free, like a lot of the other things that we do. And you can find it on YouTube. So the latest one is about fire, and we had lots of feedback about this, which is kind of interesting. Today's podcast is brought to you by Free Trade. There we go. So let me quickly share this with you. So here's me and Michael. Michael Pugh is my co-host. He's just brilliant. He's the clever one, you know, young and beautiful, and you know he should be on camera, but he's not. He doesn't like being on camera. But he's great at structuring the narrative, keeping me on a tight rein when I start to ramble like I do during these sessions. And this was about financial independence, which is an interesting topic because Michael's actually achieved it. You know, he invested early and he's done very well with his investments. And so he certainly knows about it and he's lived it. You know, he scrimped and saved when he was young, he invested, he made some good choices, and he's done very well. He doesn't talk about it. He's very private. But anyway, yeah, fire. We talked about it, and we had a lot of comments, which is kind of interesting. We don't usually get that many, but we had quite a few this time. So do have a listen. So that's our podcast, and I just shot a video today about premium bonds. So that should be fun. There is a joke in it. Anyway, look, yeah, do listen to that when it comes out. Anyway, thank you all for joining us. Please like and subscribe. Remember our community, pensioncraft.com/coaching if you want one-to-one coaching with me, pensioncraft.com/membership. If you want to learn about our membership, you get access to all those trackers. You get chat, so you can chat to anyone in the community anytime you like. You can ask questions. And you get over 300, I think, now members only videos based on questions that the community has asked over the last 6 years or so. So a really useful resource, I think. But I think the best resource is the community chat. Anyway, please do join us in the community. I'll welcome you if you do. And even if you don't, thank you for listening tonight. And take care, everyone. And good luck with your portfolios. Let's hope this turbulence ends fairly quickly.